we will carry on with the rest of this chapter about budgeting analysis, cost planning, and cost control. We have explained the role of budgeting analysis in cost planning and in cost control. We have also explained what the master budget is and how it is classified into financial and operational budgets. The master budget should be prepared in this sequence. The sales revenue budget is prepared at first, then the production budget is prepared. Following this, individual budgets are prepared for each manufacturing cost element, including direct material, direct labor, and manufacturing overhead. Following this, selling and administrative expense budget is prepared. And finally, financial budgets can be prepared using information from the previous operational budgets, including budgeted cash flows, budgeted income statement, and budgeted balance sheet. Alpha Company is a manufacturing company that plans to sell 2,000 product units this year. So number of units expected to be sold during 2020 is 2,000 product units. The selling price is expected to be $100 per unit. All of the sales are cash sales, and that sales is evenly distributed between the 4 quarters of the year. Let's now review how the sales budget is prepared. We need to multiply budgeted sales volume by expected selling price per unit to obtain budgeted sales revenue. As mentioned over here, 2,000 product units is expected to be sold in 2020. And this number is evenly distributed between the 4 quarters of the year. That's why 500 units is expected to be sold in each quarter. We need to multiply this by the $100 expected selling price per unit to obtain budgeted sales revenue. Budgeted sales revenue is expected to be $50,000 in each quarter and $200,000 in the entire year. Production budget can be computed by adding desired ending finished goods inventory to budgeted sales volume and subtracting beginning finished goods inventory. According to the sales revenue budget, 500 product units is expected to be sold in each quarter. And according to the information mentioned over here, Alpha Company had 100 product units in finished goods inventory at the end of 2019. This number can be used as the beginning inventory of first quarter in 2020. So the beginning inventory of first quarter in 2020 is 100 product units. According to the given information, Alpha Company wants to always have at least 50 units in finished goods inventory at the end of each quarter, but would like to end the year with 150 units in inventory to start the next year. So desired ending finished goods inventory is expected to be 50 units in each quarter and 150 units in the last quarter. And you need to recognize that ending inventory of a given quarter is the beginning inventory for the subsequent quarter. So ending inventory of the first quarter is 50 units. So the beginning inventory of the next quarter, the second quarter, is 50 units. The ending inventory of the second quarter is 50 units. So the beginning inventory of the third quarter, the next quarter, is 50 units as well. In the same manner, ending inventory of the third quarter is 50 units, so the beginning inventory of the last quarter is 50 units. Now we can compute required production units by adding desired ending finished goods inventory to budgeted sales volume and deducting beginning finished goods inventory from this number. Accordingly, required production units is 450 units in the first quarter, 500 units in the second quarter, 500 units in the third quarter, and 600 units in the last quarter. Now we can review direct material cost budget preparation. Required production units is obtained from the previous production budget. According to the previous production budget, Alpha Company needs to produce 450 units in the first quarter, 500 units in the second quarter, 500 units in the third quarter, and 600 units in the last quarter. This should be multiplied by direct material per product unit, and it's mentioned over here that 5 pounds of raw material are required to produce each product unit. So 5 pounds of raw material are needed to produce each product unit. This is to obtain direct material units required for production. Direct material units required for production is 2,250 pounds in the first quarter, 2,500 pounds in the second quarter, 2,500 pounds in the third quarter, and 3,000 pounds in the last quarter. Then, desired ending direct material inventory should be added, and beginning direct material inventory should be subtracted to obtain budgeted quantity of direct material units. Let's read the information we have over here. Alpha Company have 250 pounds of raw material inventory at the end of 2019. This number can be used as the beginning inventory of the first quarter in 2020. So the beginning inventory of the first quarter in 2020 is 250 pounds of direct material. Alpha Company found that an ending inventory of raw materials equal to 500 pounds at the end of each quarter is sufficient. So desired ending direct material inventory is 500 pounds of direct material in each quarter. And remember that the ending inventory of a given quarter is the beginning inventory of the subsequent quarter. The beginning inventory of the second quarter, third quarter, and last quarter is 500 pounds. So budgeted quantity of direct material units is 2,500 pounds in the first quarter, 2,500 pounds in the second quarter, 2,500 pounds in the third quarter, and 3,000 pounds in the last quarter. This should be multiplied by budgeted cost per direct material unit, and it's mentioned over here that raw material supplier offers Alpha Company selling price of $2 per direct material pound. So the budgeted cost per direct material unit is 2 pounds. Accordingly, total budgeted cost of direct material is $5,000 in the first 3 quarters and $6,000 in the last quarter. So far, we have sales revenue budget and know how many product units Alpha Company is planning to sell. From that information, we created production budget, so we know how many product units the company needs to produce each quarter. Then we figured out how much raw material we need to bring in each quarter. Now we need to prepare direct labor cost budget to determine direct labor needs. Direct labor budgets shows both budgeted hours and cost of direct labor necessary to meet production requirements. It is necessary to maintain labor force that can meet expected level of production. In specific, it is necessary to avoid running into labor shortage, and it helps in planning for potential adjustments in labor needs. To compute budgeted direct labor cost, we need to multiply budgeted direct labor hours by budgeted cost per direct labor hour. And budgeted direct labor hours can be computed by multiplying required production units by direct labor hours per unit. So, what new information we need to complete this budget? Required production units is not a new information. We can obtain this figure from the production budget. New information that we need to complete direct labor cost budget includes direct labor hours per unit. How much time does it take to complete a single product unit? And we also need to know budgeted cost per direct labor hour. cost or rate per direct labor hour. Let's figure out labor information. It's mentioned over here that one product unit takes half an hour at $20 per hour. So it takes half an hour to produce each product unit and the rate per hour is $20. We need to multiply required production units by direct labor hours per unit to have direct labor hours required for production. According to the production budget, the previous production budget, required production units are 450 units in the first quarter, 500 units in the second quarter, 500 units in the third quarter, and 600 units in the last quarter. This should be multiplied by half an hour direct labor hours per unit to obtain direct labor hours required for production. Direct labor hours required for production are 225 hours in the first quarter, 250 hours in the second quarter, 250 hours in the third quarter, and 300 hours in the last quarter. This should be multiplied by cost per hour, $20 cost per hour, to obtain total budgeted direct labor cost. Total budgeted direct labor cost is $4,500 in the first quarter, $5,000 in the second quarter, $5,000 in the third quarter, and $6,000 in the last quarter. Let's now go over what we have so far. We know our sales production schedule, raw materials cost, direct labor cost, and we also know what we will have in finished goods and raw materials inventory at the end of each quarter. Now it's time to prepare the last operational budget, the manufacturing overhead cost budget. It shows the expected manufacturing overhead cost for the budget period. In a specific, manufacturing overhead includes all the costs of production other than labor and raw material. There is more that goes into the production than just raw material and people working. We have equipment, small supplies, repairs and utilities. These things can get costly, so we need to make sure we are on top of them as we work through this budget. Manufacturing overhead cost can be classified into fixed and variable components. Variable manufacturing overhead change with the number of units produced and is frequently based on direct labor hours, such as utilities and production supplies. Fixed manufacturing overhead remains constant regardless of the production level, such as equipment depreciation, rent, and insurance. So we need to add up variable and fixed manufacturing overhead to obtain budgeted manufacturing overhead cost. Variable manufacturing overhead can be obtained by multiplying budgeted direct labor hours by variable manufacturing overhead rate, and budgeted direct labor hours can be obtained from the direct labor cost budget. Let's now check manufacturing overhead cost information that we have over here. Variable manufacturing overhead is expected to be $3 per direct labor hour, and fixed manufacturing overhead is estimated to be $2,050 in each quarter. And data about budgeted direct labor hours can be obtained from the previous direct labor cost budget. Let's now start in preparing manufacturing overhead cost budget. Budgeted direct labor hours according to the previous direct labor cost budget is 225 hours in the first quarter, 250 hours in the second quarter, 250 hours in the third quarter, and 300 hours in the last quarter. This should be multiplied by variable manufacturing overhead rate, $3 per hour, to obtain variable manufacturing overhead cost. Variable manufacturing overhead cost is $675 in the first quarter, $750 in the second quarter, $750 in the third quarter, and $900 in the last quarter. Then fixed manufacturing overhead cost should be added, $2,050 in each quarter, to obtain total manufacturing overhead cost. So total manufacturing overhead cost is $2,725 in the first quarter, $2,800 in the second quarter, $2,800 in the third quarter, and $2,950 in the last quarter. Now we can have a predetermined overhead rate for the year by dividing total manufacturing overhead cost by budgeted direct labor hours. Total manufacturing overhead cost is the number over here, $11,275, should be divided by budgeted direct labor hours, 1,025 hours during the year, to obtain predetermined overhead rate. So the predetermined overhead rate is $11 per direct labor hour. Now we have all information we need to see what our income statement will look like if we meet all of previous operating budgets. A budgeted income statement is an important end product of the operating budgets. It is prepared from the various operating budgets. It contains all the items found in a normal income statement, except that it is a projection of what income statement will look like during future budget period. Its accuracy may vary based on the realism of the inputs to the budget model. Budgeted income statement indicates expected profitability from operations. Hence, it provides a basis for performance evaluation. In specific, budgeted income statement is extremely useful for testing whether projected financial results of a company appear to be reasonable, and this can be done through comparing actual and budgeted net income. Before starting in preparing budgeted income statement, we need to compute cost of goods sold. Cost of goods sold can be computed by multiplying units sold by unit cost. Units sold or budgeted sales volume can be obtained from the previous sales revenue budget. And according to the previous sales revenue budget, 2,000 units is expected to be sold during 2020. Unit cost can be computed using information from the previous manufacturing cost budgets. And this table illustrates how unit cost can be computed. Basically, unit cost can be computed by adding up direct material cost per unit, direct labor cost per unit, and manufacturing overhead cost per unit. According to the previous direct material cost budget, 5 pounds of direct material is needed to produce each product unit, and the cost per direct material pound is $2. That's why direct material cost per unit is $10. According to the direct labor cost budget, half an hour is needed to produce each product unit, and the rate per hour is $20. That's why direct labor cost per unit is $10. According to the manufacturing overhead cost budget, the predetermined overhead rate is $11 per direct labor hour, and half an hour is needed to produce each product unit. That's why manufacturing overhead cost per unit is $6. By adding up $10 direct material cost per product unit, $10 direct labor cost per product unit, and $6 manufacturing overhead cost per unit, we can obtain total unit cost, which is $26. By multiplying unit cost, $26 unit cost, by 2,000 units expected to be sold during 2020, we can obtain cost of goods sold, which is $52,000. Now we can prepare budgeted income statement for Alpha Company for the year ending December 31st, 2020. According to the sales budget, sales revenue is expected to be $200,000, and according to the manufacturing cost budgets, cost of goods sold is expected to be $52,000. By deducting cost of goods sold from sales revenue, we can obtain gross margin. Gross margin is estimated to be $148,000. Selling and administrative expense is expected to be $41,000. By taking selling and administrative expense away from gross margin, we can obtain net income from operating activities. And assuming that there is no interest expense, net income is expected to be $107,000. That's it for today, and thank you so much for watching.